The Fed kept rates unchanged, but is Powell making a critical mistake? Markets are cheering, but something is off. What's everyone missing? Let's take a look. Now, since the last March FOMC meeting, we've had the announcement of tariffs on Liberation Day, the long bond market scare, the stock market crash, the subsequent stock market surge, sentiment slump, and yet the Fed is just focused on this idea of stagflation and that the inflation numbers are sticky, driven by potential flow through of things like the tariffs into the inflation numbers. What is Powell making a policy error? I think so, but let's take a look at these charts. First of all, let's just start off with having a quick look at what the S&P 500 is doing. It's up 16 points. The stock market itself is not making a big reaction because in the end, this the Fed did what they advertised. Everyone was anticipating that the Fed funds futures were showing that it was a 99% chance that the rates were going to remain unchanged. But really, what is going to be interesting here, I mean, Powell is speaking as I'm recording this, and it was whether or not there's going to be a hint about them potentially pivoting and swinging more dovish, and that really just hasn't been the case. But let's take a quick look at this. This is the Fed funds futures. So the first thing we want to highlight here is when we go to the June meeting, there is now a 77% chance that they're going to keep rates unchanged in the June meeting. That was closer to 70% before the meeting. So now, right now, Powell is messaging very clearly that they're not concerned about providing liquidity and easing into this marketplace. Now, by the July meeting, there's a 56% probability that we're going to get our first rate cut. That is the highest probability, but that's still a 56% probability. But then if we go all the way to the end of the year, they're basically pricing about 350 to 375 basis points, which is essentially like 3 rate cuts by year's end. And so this is where the market is settling in. And ultimately, we have a market that is continuing to show signs that is moving towards an economic recession. And what we're going to want to observe here is whether or not, one second here, what are the recession risks? And so here, you can see that the current recession risks are near 56% right now. Now, we were as high as 65% a few weeks ago, but it's still greater than a 50% chance. The big question for me is, what is the impact to businesses when they have so much uncertainty about what is going to happen with these tariffs? In the end, do you do as a big capex spend when you don't know what you'll be able to do with your product in the end? I think that there is going to be still a huge economic slowdown on the business front until there becomes clarity on what the outcome is of these tariffs. And therefore, this is going to translate into slower economy. We already saw negative GDP print. So I really believe the market is going to get surprised by how fast things continue to be going down the path which they are now, which is continuing to see conditions. I don't want to say doomsday. I don't think it's going to be a great financial crisis or anything like this. I simply think that we're going to see an actual recession, and it's going to cause earnings to contract, and it's going to ultimately impact the stock markets. Right now, stock market don't give a shit, and overall, well, my position remains that the upside of the stock market is very small. Like maybe we could see 5,800 on the upside S&P. So let's say there's 150 S&P points upside. I think that is a very realistic upside target. At the same time, if the stock market in any way gets blindsided by the data points or anything else that indicates the path from which this economy is going, we have even just back to retesting their lows, we have an 800 S&P point downside. The asymmetry of the market is skewed in the favor of the bears. limited upside with a big downside risk if something a curveball gets thrown into the market. To me, this is not a time to be buying the stock market. This is a time to be taking some chips off the table up at these higher levels. So I want to then talk about the Fed funds rate. So here's a chart. We see the Fed did some rate cuts last year. Really has been doing nothing since the Trump administration has come in. This is another big question. Is there an agenda by the central banks to essentially, not support Trump's actions by accommodating the economy from his actions? And that's a big question. Like, are we going to see the fact that they are going to be late to the party? And that is a very typical thing, which is usually something breaks in the market, and then the Fed is eagerly rushing to have to cut interest rates in order to fix the problems and provide liquidity to fix the problems that they've caused by not providing liquidity sooner. The other, here I want to just touch on the Sulfur Futures, which is we're going out to December of 2026. We're looking at the secured overnight lending rates of interest rates as they're projected out forward. Right now, we remain a year and a half out near 3% interest rates. As far as I'm concerned, when this recession really kicks in, I think we could see 2% interest rates or lower. This continues to be one of my favorite places for trades, where I don't think that we're going to see two rate cuts pulled out. So I don't even think there's like a 50 basis point downside risk to this. And if this runs, you've got at least 100 basis points upside on this trade. And so for me, the Sulfur futures are a big focus. So as far as I'm concerned, stock markets highly vulnerable here. There's a downside risk back down to the previous lows at minimum. And I think that there's an opportunity to be betting against the Fed on policy error, that there's going to be more rate cuts in the next year than the market is currently pricing. All of this makes sense to me, and I'm going to continue to press those types of trades with my members at Big Picture Trading. All right, everyone. Thanks for joining me. I hope you enjoyed the update.